Hey guys, welcome back to Finance for Firefighters. Today's topic is going to be income tax brackets. So we all pay taxes in several different forms, but I felt like it was important to cover some basic stuff on income tax brackets, some basic concepts, some basic terms, things like that. So I'll discuss a few things and then we'll dive into some examples and actually show you how all of that breaks down for how you are actually paying your income taxes on a federal level, and then also your state income tax, at least specifically to California, because that's where I'm at, and that's where the biggest target audience I'm looking at discussing this with. So we'll dive in today and we'll talk about some stuff related to your income tax brackets. So a term you've heard before, but I'll just kind of discuss it with you, is adjusted gross income. This is basically the gross amount of money that you're paid. Taxable income would be the adjusted gross income minus your deductions. And then net income would be all of your deductions take out, and net is basically your take-home pay. So federal income taxes, and in our example today, state income taxes for California, are paid in a layered system, basically. So from a certain amount of money to another certain amount of money, and we'll get into the specifics here, but from 0 to roughly 11,000 for single is paid at a 10% rate. So all the money you make between 0 to 11,000 is paid at a 10% income tax rate. 10% of that is paid for that, and so on and so forth. So you don't pay a certain percentage, like, hey, I pay a 30% income tax. You're not paying that whole thing on what you're making. You're basically, it steps up, and sort of like if you think of layers in a cake. The first layer, you're paying the smallest amount. The next layer, in that piece of it, you're paying slightly more, slightly more, and so on and so forth. So the more that you make, that top end of your income, the last $30,000 or $40,000 worth of your income, is actually paid the highest percent taxes on that. So those are all called marginal rates. Each one of those is a different margin that you're taxed at. And then the effective tax rate is basically the average of all of that. So knowing these differences and having some strategies for you will make a huge difference in what you're doing for how much you're withholding, or even if you decide to go exempt, or if you're working a bunch of overtime shifts, things like that, you may want to strategize a little bit depending on your specific circumstance for different write-offs and stuff that you have. But if you change a few things, you're able to reduce some of your income taxes, or at least have some of them come back to you earlier instead of getting a large refund at the end of the year.
All right, so at irs.gov, we've got our federal income tax rates. We've discussed sort of how some of this is put together between a marginal and effective tax bracket, but this should help sort of illustrate it. So if you're ever not sure what it is, because every year it changes with inflation, this table here, if you just Google it, it'll bring a table up for you, and depending on the certain situation you're in, you can find out exactly what you're taxed between certain amounts of income. So between 0 and 11,000, you're taxed at 10%. The money you make between 11,600 and up to 47,150 is 12%. And then as your income increases, so does the tax bracket, and it tops out at 37% if you make over 609,000. Obviously, the vast majority of us are not in this area, but the combination of all this kind of stuff makes it really difficult to understand exactly what you're taxed at. But if you come here to the irs.gov, that'll show you at least your federal income tax portions that you're responsible for. So to look at your state income tax brackets, I use a similar search. I basically just search for California state income tax. And in here, it's got a 2024 amounts. If we scroll down, we can look at the different rate schedules that they have for them for 2024. So if I click on this, it shows the same, it works effectively the same way that the federal income taxes work. Between two thresholds is taxed a certain percentage, and as you make more money, you're taxed at higher percentages between those two numbers. So from 0 to $10,000, you're taxed at 1%, and then between 10,000 and up to 25,000 and change, you're taxed at 2%, so on and so forth as your income level goes up. So we've got federal income tax, and then if you live in California, state income tax, which is set up the same way. You have a marginal rate, so these layered sections that you have is what you're taxed at marginally up to the highest number you're at. And then your effective tax rate is basically the combination of all that to find out what the average amount you pay in your income taxes are.
All right, let's talk about deductions. So we have standardized deductions and you have itemized deductions. The standardized deductions currently is for singles about 15,000, and then federal, and then for joint, it's about 30,000. So what does this mean? So if we take that example of that top step firefighter that works in Sacramento, makes roughly 120,000. instead of having those marginal rates go up for the state and the federal income tax level going up to the 120,000, the government says we are going to allow you to take $15,000 off of that top end, so 120 minus 15,000 if you're single, and that's basically the top end of what you're going to be taxed at. So instead of being taxed from 105 to 120,000, they're only going to be taxed up to the 105,000, paying that highest percentage. And then if you're filing jointly, that's roughly twice that, right? So it's about $30,000 for that. So instead of them making $120,000 if they're married filing jointly, it shows that they've only made $90,000 in the eyes of the federal government, right? If you itemize, depending on, again, if you have personal business or you have lots of different expenses, you have medical bills or a ton of other things that have popped up, you can actually itemize your deductions and potentially have more to take back. So it's basically showing that your income has been brought down from that adjusted gross income has been brought down significantly more if you itemize versus if you use the standardized deductions. Now we'll dive in today and we'll talk about some stuff with federal and then state income tax, single and jointly, how all of those specific things are broken down and what the different rates are from the marginal end, and then how that translates to what the effective tax rate is, or the average tax rate would be for you for income taxes.
All right, so we've looked at some, or we will look at some calculators that'll do a lot of this for you, but this spreadsheet here has broken everything down and is a little bit more of a visual to show exactly how taxes are paid. So again, just me nerding out on Excel with this, but we have two different scenarios. We're going to say that there's a firefighter, top step firefighter from Sacramento, single, and then another one joint that have the same adjusted gross income of $120,000. So for the single firefighter, for adjusted gross income of $120,000, coming down here, instead of putting it in the calculator, I've just physically done all of this to show the exact amount of federal income tax this person's paying. So between or let's back up a little bit. We had discussed before about a standard deduction versus itemized deduction. So a standard deduction is basically the federal and state each do this. They say, hey, we're going to allow you to take this certain amount that lowers your gross income by that amount, that will basically bring you down on the threshold of it. So the standard deduction in this case is for federal is $15,000. So take $15,000 and we're going to take that away from $120,000. So instead of this person making $120,000, the government's going to say, hey, it looks like you make $105,000 because we're giving you the single deduction. Okay. For state, it's lower. They're allowing you to lower it by $5,500. So instead of making $120,000, this person makes $115,000 is how the state's going to be taxing you on it, at least for a single person. So for the single person, between the 0 to 11,000 and change, the total amount of taxes paid is 10% of that amount of money. So 0 to 11,000 is the 1,192.5, right? Just moving zeros over a little bit. The next spot is the portion between 11,000 up to 48,000 for somebody who's single. So this portion of money is a little over $30,000, and it's taxed at 12%. So that's the total amount of taxes you're paying between these two amounts on your income. Next step up is 48,000 to 103,000. They're paying approximately $12,000 in there. And then from here, 103 up to the 197, it's a much smaller number. Because of this deduction here, again, the government is looking at you, instead of making the 120, they're looking at you as if you make 105. So it's really only 103,000 up to 105,000 that you're getting taxed at that 24%. Okay. So the total amount of taxes federally for somebody who's single is about $18,000, right? So all these things physically added up and then put in this spot here. FICA is the same across the board. So, take the amount of income that you have and you multiply that by 7.65, and that equals to 9,100. That's nothing you can do about that. And then if we look at the single person who makes the 120,000 and minus the deductions, we go through the California one. So between 0 to a little over 10,000, you're paying 107, right? You're paying 1% of that, which is, moving the decimal places over a couple for that, right? $107 in taxes. Between 10,000 and 25,000, you're paying another $294, which is at that 2% rate, and it just keeps increasing. So between 25 to 40,000, you're paying $589. That's the difference between this number and this number times 4% is here, right? And you work your way down up to the maximum amount. So for this person, for California, is saying they make 120,000 minus the 55 and change. That's going to take them to about 114 and change. So between 70,000 to 114,000, because they don't make this much money, they're taxed at about $4,000. So the majority of the amount of taxes they're paying is coming the last part of their income. The last, 40-something thousand dollars is getting taxed, that higher percent at the 9.3%. So you add all these numbers up, and that's where the $7,100 comes from on this single person. And then if we look at this graph, it basically just takes all this data, puts it in here, and it says, hey, if they make 120,000, the total amount of net or take home that they're getting is about 71% of their income. So the total amount of taxes they pay between federal, state income tax, and FICA is almost 30% for somebody who's single. So another Google search, I just searched for California income tax calculator. I found one on this smartasset.com. It's been pretty useful. There's ads and things like that, but the majority of what you're looking for here, if you want to find your estimates, is pretty straightforward. So the examples we've run before, like I showed on the Excel spreadsheet, by breaking everything down and showing exactly what each amount is. If I come in here and say that the gross adjusted gross income for a top step firefighter is 120,000, I can come over here. We'll start with single first, and I'm not doing any 401k or 457 in our case contributions here. I just enter. Down here, it's going to be a breakdown of all of these different areas, right? So my federal income tax in this case, the marginal tax rate, the highest that somebody is taxed at, is 24% for this person. And then the effective tax rate, or the average tax rate, is actually about 15% because it's layered. You're not paying that whole amount. You're only paying the 24% on the top part of your income level between those brackets we looked at. FICA, like we talked about before, this has a flat amount of 7.65 currently for taxes. State income tax for this is showing California state income tax of 9.3%. Local, I didn't put anything here because there are different things in different areas. So depending on where you live, if you have Mello-Roos or there's any other local taxes that are levied on top of it, you would pay higher income taxes. But just breaking down the main ones with federal income tax, FICA, and state shows what this person would be paying in taxes or have to pay at the end of the year. So total amount of taxes for federal would be about 18,000. Total amount for FICA is a little over 9,000, state a little over 6,000, total income tax of 34,000. So even though the adjusted gross income is 120,000, the total amount of taxes paid is 34,000, giving them a take-home or a net income of 85,000 after taxes are paid. So let's look over at the top step firefighter that's filing jointly that says the same gross income. Because the tax brackets are higher for them, they're going to be paying a lower percentage in taxes and therefore less in taxes. So if we look over here, down here the joint brackets for federal income tax, between 0 to 23,000, they're taxed at this 10%. And then they top out because of the higher amount of standard deduction. Instead of making 120,000 to the government, they're only making 90,000 to the government. So because of this, they're taxed between 23 and some change up to 90,000, right? So the difference between the two of those numbers times the 12% equals this total amount of taxes. So the total taxes they pay, they're only going into two different brackets, right? They're going to the 10% and the 12%. And the total amount of this is $10,000. So you can see there's a significant amount of difference here, right? Because this person is filing jointly. And then looking down at the California taxes, same kind of thing applies, right? They're not paying up into this 9.3 or 8% because they're filing jointly. The standardized deduction for California is twice as much, right? So instead of paying, the California thinking they pay $120,000, it looks like they're only making a little over $109,000. So they're only taxed on that amount. So there's fewer brackets they're getting taxed on at that higher amount, right? So again, numbers are higher. All of this is roughly double what this other one is. Paying 1% between these two numbers, they're paying 2% between these two numbers, the difference of these numbers, and then so on and so forth. So the total amount of state taxes is only $3,600. Again, significantly less. If we come up here, we see that those numbers have applied over to here. So adjusted gross income, 120. Federal income tax is only 10,000. State income tax, a little over 3,000. FICA, that's the same amount, right? 7.65. It's identical on both sides. So the total net for this person who's joint is 96,000 versus this other person filing single is 85,000. You can see on the comparison between the two charts also, instead of having a take home of 71% of their income from their adjusted gross income, this one, this filing jointly, you're taking home 81%. You're paying significantly less in taxes and income taxes across than somebody who's filing single, right? Okay, now let's run the example of changing this person to married because now it's a family or two people splitting the income, which is why the taxes are reduced. So if I put that same amount in there and I just press enter, come down here, the marginal tax rate, the highest this person is going to be paying is going to be 12%, and the effective tax rate or the average taxes they're paying federally is a little over 8%. FICA is the same for everybody. State income tax, California is 6% for the marginal, and then the effective or the average amount they're actually paying is 2.8. So the total amount of income tax is 19%. Total amount of tax paid total is 23,000, leaving a take-home income of 96,000. Higher take-home for somebody who's married or filing jointly because they're paying less income tax because there's a higher threshold of income in that tax bracket for somebody who's filing jointly versus single.
All right, so we've discussed some federal income tax, some state income tax, how all that applies, at least in California. Another thing we'll talk about is FICA. I think I'll dive into that in some of these examples also. But FICA is basically that it's a 7.65%. You'll see it there as a deduction on your check. What FICA is it pays for Social Security and it pays for Medicare. So recently in California, we've had moved over to where if you've actually worked and paid into Social Security, you're actually able to qualify for that now. Before, we weren't able to do that because of our pensions, but recent legislation allows us now to be able to actually get Social Security when we retire, so at least a portion of it, depending on how much you put into it, which is nice because right now we're paying into it. So it's good to be able to actually get the benefit from that. So FICA is set up as a flat tax rate. So it's 7.65% of whatever you make, that it is what it is on that part of it. So the income taxes you're basically paying are FICA, state, and federal income tax. And depending on how much you make, the more money you bring in, the higher your amount of taxes is that you pay between federal and state. But FICA is flat across the board for everybody while you're working. Okay, one last thing to discuss on this is a lot of folks do this where they work a bunch of overtime, or they go out of county and they're gone for 2, 3, 4 weeks, whatever, things like that. And they say, hey, I want to go exempt on this next check so I can get all of that money, right now, instead of waiting until the end of the year to do that. Make sure when you're doing this that you're strategic about it. So depending on your tax bracket and how much you're typically going to be paying at the end of the year, you can do some of these calculators like I've shown you to have like an estimate of, okay, what's my normal gross income, about how much overtime have I worked, to be able to sort of extrapolate out how much you need to pay in the end of the year. If you're going to be going exempt, usually that's fine to do depending on your situation. I want to give a blanket statement, but usually that's fine to do maybe once. But if you do it much past that, and let's say you're like, oh, I have access to all this money right now, and you're not paying taxes on it, or you're paying significantly reduced taxes on it, you're going to have to pay eventually at the end of the year. So if you do that, make sure that you either adjust your withholdings to take more out, after you've done that, or make sure that you at least have cash on hand to be able to pay that tax bill when it's due, so that you don't just put yourself in a bad spot after that. Another couple ways that are good of reducing some of your taxable income if you are working a lot of overtime, depending on your department, is for us, we're able to do comp time, right? So if I was going to work an entire shift for a 24-hour shift in overtime, I'd make 36 hours of straight pay equivalent, right? Or time and a half of that 24 hours. And I'm taxed on that overtime as if I made that snapshot amount of money, that time and a half, all the time, right? So that's why a lot of folks go exempt, is because the government's taking a big bite out of that right away, thinking you make that whole amount over it, right? Now, if I don't work overtime, you know, if I'm not doing thousands and thousands of hours a year, if I'm only doing a few hundred hours of overtime a year, and at the end of the year, I tend to get a big return back because the government has taken it out as if I made that huge amount of money all the time, when in reality, I don't. So if you are going to do the withholding piece of it, there's definitely some strategy you should do. You have to really extrapolate how much you're going to have. Maybe talk to your CPA or your accountant about exactly what you should do with your withholdings, depending on if you're married or if you have kids and things like that. And then really try to map it out so that you're getting at least a small amount back, or try to break even. If you owe a ton or you're getting a significant amount back, that's usually not ideal, right? If we get a significant amount back, that feels great to get this big chunk of $10,000 or something like that. But all you really did was basically gave the government a tax-free loan for the entire year. And then they were able to have your money, and then now you get your 10 grand back at the end of the year, right? So, you know, depending on your situation, your personal stuff, what you like, if you like having that big check come at the end of the year, great. You know, if you do it that way, I would encourage you to take that amount of money and use it to pay off your mortgage, or, you know, throw it at some sort of savings that you're going to be using to, you know, or investments or something like that, if you're going to be using a huge chunk of money for that. But I definitely wouldn't wait on that to be able to pay off your bills at the end of the year, right? So, yeah, just a little summary on that piece of it. All right, guys, thanks for joining me today on Finance for Firefighters. I appreciate your time. Same as always, if you have any comments, leave them below. Give me a thumbs up if you like it. I'll see you guys on the next one.